This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Obamacare is the law of the land. It's going to remain the law of the land until it's replaced. We did not have quite the votes to replace this law.
Bill pulled. House Republicans yank their health bill minutes before it was due for a vote, leaving investors scratching their heads.
Affordable housing? Why some investors may be starting to get cold feet.
Gridlock on the ground. What's being done to alleviate traffic jams on the tarmac? Those stories and more tonight on Nightly Business Report for Friday, March 24th.
Good evening, everyone, and what a day it has been. Drama in Washington. Minutes before the Republican health care bill was due for a vote on the House floor, leadership pulled it, unable to garner enough support, and marking the first legislative setback for the Trump administration and House Speaker Ryan. Speaker Ryan now telling fellow Republicans they're moving on, but it won't be easy.
Yes, this does make tax reform more difficult. But it does not in any way make it impossible. We will proceed with tax reform. We will continue with tax reform. That's an issue I know quite a bit about. I used to run that committee. I spoke with the president, the Treasury Secretary, and his economic advisors earlier today about tax reform. So we are going to proceed with tax reform. This makes it clearly more difficult.
John Harwood is following the story from Washington. I don't remember, John, a day quite like this one in decades. Is there any possibility that this health care repeal and replace gets resurrected later this year, even before the midterms next year?
Yes, but I think expectations are going to be quite low for what that produces. This was the moment when you had a new Republican Congress, a new president at the peak of his influence, and I should say it's not a high peak because his approval ratings are pretty low. But nevertheless, your greatest clout is when you begin your presidency. This was a top promise for Republicans. And when they outlined this plan, they simply could not get a majority of their caucus, even with a large majority in the House. What that suggests, and President Trump alluded to this after the defeat, was that whatever they come up with later might involve Democrats, which necessarily means it would be a much smaller revision that could be categorized as a fix to Obamacare. And interestingly, that is precisely what former House Speaker John Boehner predicted a couple of months ago would be the outcome.
Now, Paul Ryan, the president got praise for Paul Ryan, or gave praise to Paul Ryan for working so hard. However, he wasn't able to deliver the votes. What does that mean for his leadership going forward as they start to tackle tax reform and infrastructure?
It's a blow, Sue, to the prestige of both Paul Ryan, the leader of this Republican House, and to President Trump. He said he was the master negotiator, the closer. His aides had confidently predicted that he would get the votes for this. They both failed to do that. Now, each issue is different. Tax reform inspires a lot more consensus within the Republican Party. I still believe they will be able to pass a corporate tax cut later this year, may not be able to get the broad comprehensive reform. Infrastructure will be a tricky challenge, sort of like health care, because he may need some Democratic support to push it through.
Is gridlock dead, or is gridlock alive and kicking when a minority of the majority can really control what gets done and what can't?
It's a very good question, Tyler, and it's relevant because we have seen this modern Republican Party have a faction within it that is so anti-government that it is very difficult for them to get to yes on any government program. So while we've talked in the past about Republican-Democrat gridlock under President Obama and under President George W. Bush before that, we could have a situation here with this idiosyncratic new president where he can't get a consensus within his party on important things. That is new territory for us.
All right, the weekend shows are going to be fascinating. John Harwood, thanks so much.
Well, the drama in Washington rippled through Wall Street. Shares of hospital operators finished higher on relief that the benefits that sector has seen from Obamacare will not go away, at least not for now. Medicaid-focused insurers also rose, stocks like Centene and Molina Health and WellCare. But the broader market appeared confused after the vote was pulled, moving down, then up, and then down again. The Dow Jones Industrial Average closed lower by 59 points to 20,596. The Nasdaq rose 11, and the S&P 500 fell nearly 2. And today's action capped the biggest weekly percentage loss of the year for the major indexes. Bob Pisani explains the late-day market moves.
Stocks ended modestly weaker, with the Dow down just 59 points. But that small drop does not describe the high drama we saw today. The markets dipped when it looked like the bill would fail if it went to a vote, but then rallied when word leaked out that the president was pulling the bill rather than call a vote. Why the rally? Traders said that keeping the Obamacare repeal bill alive, even if nothing will happen for months, was important because getting rid of the taxes embedded in Obamacare would help offset the corporate tax cuts the president is proposing. Now, for the week, the Dow was down 1.5%. That's its worst week since September 9th. Now, traders right now are very eager to move on to two other topics. First, a tax cut, and then earnings. Next week is the last week of the quarter, and with earnings up 10%, the best showing in nearly 6 years, traders are eager to change the subject to an improving economy. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The CEO of Charter Communications was at the White House today to announce its decision to invest in broadband infrastructure, move offshore call centers back to the U.S., and create 20,000 jobs.
We also committed to spend $25 billion in infrastructure capital over the next 4 years. That's the deployment of new infrastructure, which also creates jobs. And the whole thing is really predicated on an opportunity to live in a better regulatory climate with more consistency, a better tax climate, which is really conducive to making investments both in people and in infrastructure.
The second largest U.S. cable company had previously disclosed plans to hire 20,000 workers as part of its acquisitions of Time Warner Cable and Bright House Networks.
Eli Lilly is also making an investment in U.S. operations. The drug company plans to spend more than $800 million on its research labs and manufacturing sites. According to the company, the investments are being driven by demand for Lilly products as well as its pipeline of medicines that target things like cancer and diabetes.
President Trump formally green-lighted the construction of the controversial Keystone XL pipeline, reversing an earlier decision by the Obama administration. The president called it part of a new era of American energy policy that he says will lower costs and create jobs.
Today, I'm pleased to announce the official approval of the presidential permit for the Keystone XL pipeline. TransCanada will finally be allowed to complete this long overdue project with efficiency and with speed. We're working out the final details as we speak. It's going to be an incredible pipeline, greatest technology known to man or woman, and frankly, we're very proud of it.
Shares of TransCanada, the company behind the pipeline, fell just slightly.
So while much of the focus has been on Washington, politics down there, the U.S. does find itself awash in oil. U.S. crude stockpiles, record levels, leading some to predict that the nation will be oil independent within a decade. If so, what will this mean for the U.S. and our ties to the Middle East? Kyle Cooper is Director of Research at IAF Advisors, and he joins us now to discuss. What would it mean if the United States were finally, once and for all, to achieve something that was talked about back in the 70s, true independence from foreign oil?
Well, certainly it changes the geopolitics significantly, right? For the last 10, 20 years, or 20, 30 years, our focus has been on Middle East stability because we relied so much on the oil coming from there. Now, with the Keystone pipeline being approved, with additional supplies presumably coming from Canada as a result of that. And then, obviously, most importantly, the development of the U.S. shale oil. The North America is really on the verge, or certainly has the possibility of becoming energy independent in a decade or so. And
does that necessarily translate to kind of permanently lower oil and gasoline prices or not?
Would certainly think so. The U.S. E&P companies have made tremendous strides since 2014, the last time we saw oil above 100, in reducing their costs and increasing their efficiencies. Many companies now report that even at $45 and $50, they're actually more profitable today than they were when prices were above 100. So it certainly seems that we have the opportunity for a much longer time of oil in the 50s or, right around this area because of the improvements in efficiency and the oil that they can supply at these levels.
What investable U.S. companies are benefiting from this, Kyle?
Certainly the mid-caps that already have exposure in the 7 U.S. shale regions that the EIA's drilling productivity report focuses on, those for oil primarily being the Bakken and the Permian, but really the ones that are probably most in store for additional business and revenues are the service companies. Regardless of whether or not the E&P is small or large, they still have to go to the service companies for the fracking technology, the sand, the pipe, the steel to put in these,
Those service companies include, name a couple of them.
Well, certainly like the Baker Hughes,
right,
the Halliburtons, the Schlumbergers, some of the sand companies, those types of companies that specialize in the actual services to the oil company and to the drilling projects. Those are the ones that every company has to go to. So certainly those types of companies are really poised for an increase in their business in the coming years.
Does it also change our relationship with Canada, our northern neighbor?
Absolutely. With obviously Trump's now permitting of the Keystone pipeline, this helps the Canadian oil sands producer because just as the U.S. producer has lowered their service costs primarily through lower service costs, a pipeline generally is much less expensive to transport on. And thus, the net back for the Canadian oil producer, for the Canadian oil sands producer, gets lower or gets increased because their transportation costs are lower. So their economics improve because now they have less cost to get their oil all the way down to the Gulf Coast and into the U.S.
Kyle, you're always clear and concise. I appreciate it. Kyle Cooper, IAF
Thank you. Have
Advisors.
a great weekend.
You too, sir.
Some new insight today into the health of the U.S. economy. Order for durable goods, products designed to last at least 3 years, rose 1.7% in February from the prior month. That was more than expected. Market watchers say that this report is the latest evidence that the recent pickup in confidence has translated into stronger capital spending overall.
The president of the New York Fed says the economy is in a pretty good place right now as it inches closer to full employment. Bill Dudley, an influential Fed official who has a permanent vote on interest rates, added that rising interest rates will be a delicate adjustment for the economy.
By taking out a little bit of that accommodations, moving up interest rates just a little bit, we think it's more likely that we'll achieve a soft landing and keep the economy about where it is today in terms of employment and inflation. So it's a delicate adjustment. It's not something that's very harsh. We think it's appropriate and necessary. But I think the economy will be able to adjust to this just fine.
He also said that the unemployment rate is pretty close to its lowest level without sparking too much inflation.
Still ahead, are you looking for growth? Our market monitor says it's time to invest your money in some very well-known companies. The Senate voted to undo Internet privacy rules. Those rules were approved by the Federal Communications Commission last fall and had not yet gone into effect. The regulation would have required Internet service providers to get permission before collecting and sharing your information, like your web browsing history or your location. Senator Jeff Flake introduced the resolution to repeal the rules, calling them unnecessary.
While the market has high hopes that the corporate tax rate will be lowered, it is a different story for some real estate developers. Just the idea of a tax cut is rattling the low-income housing market. Aditi Roy explains why from East Palo Alto, California.
This low-income housing project in San Jose, California just broke ground, but it almost didn't happen. Developer Jeffrey Morgan says it took years for him to line up the investors, partners, and builders for the 2nd Street Studios, a housing development for the homeless, where residents of the 134 units would pay 30% of their income towards rent. A typical one-bedroom apartment in San Jose goes for about $2,000. Then came Election Day.
In a nutshell, we got trumped.
By that, he means President Trump's election victory rattled the low-income housing market. That's because once Donald Trump won the election, a cut in the corporate tax rate became more likely. If that happens, investors won't get as much financial benefit from buying low-income housing tax credits. So housing developers are saying some investors are getting cold feet, including the one behind the 2nd Street Studios.
We were literally driving to the title office after signing documents with the city of San Jose, and when we were ready to go, they backed off. And our lenders committed anyway, and we wound up meeting with the investors later on, but it was a really scary time.
Eventually, the investors stayed in the project, but renegotiated the financing, leaving Morgan with a $2.5 million funding gap. The city of San Jose stepped in and paid the shortfall, saving the project. Morgan isn't alone. Experts say shovel-ready low-income housing projects across the country are in jeopardy of losing funding because of uncertainty in the affordable housing tax credit market. Public accounting and consulting firm Novogradac estimates the low-income housing tax credit market could lose 10 to 15% of its value. The problem could be especially acute in California, where the housing market is tight. In the Bay Area, skyrocketing rents and low inventory have prompted some companies like Facebook to step in. The social media company launched a $20 million initiative for affordable housing. The good news is most developers say the uncertainty around where the corporate tax rate will end up is just a temporary disruption in the market, one that will likely smooth out once we find out what the corporate tax rate will be under the Trump administration. For Nightly Business Report, I'm Aditi Roy, East Palo Alto, California.
Finish Line shares plunged to their lowest level in more than 6 years, and that is where we begin tonight's market focus. The athletic wear retailer posted a wider than expected loss, a drop in same-store sales, and poor profit margins. The company's CEO blamed the poor results on some footwear products that didn't resonate with customers, along with difficulties in the overall retail environment. Shares of Finish Line fell nearly 20% to $12.93. Blackstone sold its 21% stake in SeaWorld to a Chinese investment firm. As part of the deal, SeaWorld will provide support for developing theme parks in China, Taiwan, Hong Kong, and Macau. Shares of SeaWorld rose nearly 5% to $18.13. And Twitter is reportedly considering a paid subscription option. The social media platform is conducting surveys to assess interest in an enhanced version of its TweetDeck feature aimed at professionals. Twitter shares up more than 1% today to $15.14.
Medicare patients with diabetes will be eligible to receive reimbursement for Dexcom's continuous glucose monitoring system. The U.S. Centers for Medicare and Medicaid Services clarified criteria for coverage of Dexcom's device yesterday. On the news, the company up nearly 9% to $82.62. Moving the other way, U.S. Concrete said its CFO will resign effective July 1st, and the company is also replacing Grant Thornton as its primary accounting firm. Additionally, a private law firm is investigating on behalf of shareholders whether the company's officers or directors have engaged in securities fraud or other unlawful business practices. All of this adds up to a 9% drop. Concrete overshoes in U.S. Concrete. Those shares closed at $60.80 today.
This week's Market Monitor is finding opportunities in some big tech names he says are leading the way in both cloud computing and mobile advertising, and who could see their stocks rise as much as 20% over the next year and a half. He is Tim Courtney. He's Chief Investment Officer at Essential Wealth Advisors. Tim, welcome back. Nice to see you again.
Yeah, thank you very much.
Let's get right to your picks. Microsoft is number one, a very large cap company.
It is. Microsoft really missed some of the movement out of PCs and into mobile, but the current leadership there is really trying to position the company to get in front of some current trends, and cloud computing is one of those. It currently is the second largest provider of cloud services, behind Amazon, and they spent $12 billion last year in research and development. And they're a leading firm in terms of artificial intelligence and deep thinking software. So their most recent price to earnings is less than 20. They've got very good cash flow. They have $120 billion of cash overseas that, if repatriated, could be very useful in buying back shares.
Let's move on, Tim, to another company that really nobody else would have heard of but you and me, another small one, Google's parent, Alphabet. My question, you like it,
Yeah.
but, you know, Alphabet has been in the news this week over the concern that many big companies have pulled ads because they are worried about adjacencies of their ads with content that many would find objectionable. That isn't a real problem in your mind, or is it?
Well, it is, and I think that also speaks to the footprint that Google has. They're probably one of the most innovative companies. They have such a huge reach that they are going to run into these problems. And so I think that their growth, however, and their current valuation more than makes up for some of the problems that they're seeing. They also are in cloud computing. They're the third largest provider in cloud computing, a huge growth market. And Waymo, their self-driving car unit, they're either in the lead or very close to the lead among their rivals in that, which is a future growth area. And so they're very large. They're going to run into some bumps, but they're trading at a less than 20 price to earnings, future price to earnings. Very little debt, very good cash flow, and they look appropriately priced.
And another mega cap we'll finish up with, Facebook.
Yes, the undisputed online advertising leader. In fact, almost all their revenue comes from online advertising. I think they and Alphabet together make up about 70% of the market in online advertising. And Facebook is approaching about 2 billion active users each month. So they have $10 billion of free cash flow each year, and their earnings are growing faster than their share price has grown over the last several years. So their price is just slightly above a 20 price to earnings, but very reasonable for the growth that they're generating.
All right, Tim, we'll leave it there. Thank you so much. Tim Courtney
thank you.
with Essential Wealth Advisors.
And coming up, cutting airport congestion.
Tired of those traffic jams keeping your flight from taking off? I'm Phil LeBeau in Chicago with the story of one airline making changes so that you can get off the ground sooner. That story coming up on Nightly Business Report.
Credit reporting company Experian's been fined $3 million. The Consumer Financial Protection Bureau alleges that the firm misrepresented the credit scores it marketed to consumers. The federal regulator said in some cases there were significant differences between what the company provided to consumers and the score used by lenders. Experian has not admitted to any of the agency's allegations.
As the spring vacation season picks up, it brings with it a chronic problem at many airports, congestion and delays. But the Trump administration says renovating many of America's airports and upgrading the country's air traffic control system could ease those backups. Phil LeBeau has more from Chicago's O'Hare Airport.
It is frustrating and all too common. Your flight leaves the gate, but you're stuck in a traffic jam on the tarmac.
You see a lot of people pull out their cell phone. They're saying, well, I have this meeting and we need to reschedule.
It's not very fun. Usually there's not a lot you can do. You just have to sit there and wait.
While the FAA has been upgrading its systems to improve the flow of flights in the U.S., the reality is airlines have been padding their schedules so planes have a better chance of taking off and landing on time. That means the time set aside for flights like those from Washington to New York or Las Vegas to Los Angeles is up more than 10%. Those longer schedules are due in part to congestion in the air and on the tarmac at some of America's busiest airports, a problem many airlines believe can be fixed by upgrading America's air traffic control system.
Ultimately, we want the pilot of the airplane, the air traffic controller, the dispatchers at the airline to all have the same information at the same time with which to make the best decisions.
American Airlines is already trying new approaches to improving the flow of flights at its hubs.
4733 Clinton, November, Charlie Gate, 31 off.
But the big improvement for all airlines could come if President Trump can convince Congress to spend billions to fix America's airports, and by extension, the traffic jams clogging up airspace over America's busiest airports.
I think there's a lot of work underway today, and there's things that are coming out in the next 2 to 3 years. There's some technologies that can make a huge difference that are probably planned out over a 10 or so year period.
Fixing airports and air traffic so travelers spend less time in a plane and more time at their destination. Phil LeBeau, Nightly Business Report, Chicago.
And finally tonight, have you been distracted by March Madness while you're at work? You're not alone. A new study by Challenger Gray and Christmas estimates that for every hour spent rooting for a team or analyzing a bracket, employers lose a collective $2 billion. I'm not paid $2 billion an hour. I don't know how that works, but trust me, it works. March Madness also considered the third biggest digital distraction at work. The first, texting, Sue. The second is time spent on Facebook.
I don't text, and I'm not on Facebook.
I'm not on Facebook either.
I do look at a bracket every once in a while. Okay, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Have a great weekend, everyone. We'll see you Monday. I'll text you, Sue.
You got it. I'll text you right back.
All right.
Nightly Business Report has been funded in part by
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.